can hear me. Good evening, everyone. It's a delight to be here on stage at such a great event in the Indian gold market calendar. I'm really looking forward to the schedule of discussions that are lined up for the next couple of days, and I know very much that they're focused on your domestic market, the challenges you face and the changes that are afoot. My presentation today will be more of the global context to that. The backdrop of global gold demand is a topic that the World Gold Council are well known for, the insights and data on global gold demand that we publish in our quarterly Gold Demand Trends publication. So in terms of the agenda, most of what I discuss will be a look back at 2023, an overview of the different sectors of demand, some of which have already been referenced in some of those introductory speeches. I'll then take a look at where we are so far today in 2024 and what the rest of the year might hold. So obviously, as you'll be very familiar, the gold price has been hitting the headlines in the most recent weeks. Just yesterday, I think we hit a new high for the LBMA PM price. But I think it's very important to take a bit of a step back and look at gold price in a longer term context, and to note that it was already on a very strong upward path throughout last year. It was one of the best performing assets globally in 2023 and generated returns of 15%, both in dollar terms and in Indian rupee terms. And if we, at the World Gold Council, we very strongly believe that the fundamentals of demand and supply are really important in helping to both understand and explain why the gold price moves in the way that it does. And if we look at annual demand for last year, we can see this is broken out by sector of demand. It was very healthy. It didn't quite match the strength of demand that we saw the previous year in 2022. But on a longer term basis, it was very healthy and it was stronger than the average levels that we'd seen in the previous 10 years or so. Now on this chart, two bars stand out to me in particular, and that's central bank demand, which is the light green bar, and jewellery demand, which is the purple bar. We've already, as I said, referenced the central bank buying. It's just been noticeable for its sheer size over the last couple of years. But jewellery demand, I think, is notable as well for its resilience. In the light of what's happened with the gold price, it's held very stable. I'll go on to talk about all of these sectors in more detail. But the first and most important, and the one that's probably had the most headlines, is the central bank buying. It's been a major story for the past 2 years. In 2022, we saw central bank demand rocketing to a record of nearly 1,100 tonnes. That was far in excess of what we had actually been expecting at that time. But then we saw an almost exact repeat of it last year as well. They bought more than 1,000 tonnes for a second consecutive year. And if we look at the green line, that shows how much they've been buying over the last 10 years in total. And so cumulatively, since they became net buyers in 2010, central banks have bought more than 7,500 tonnes of gold, adding those to their global official reserves. We've got a dedicated and very well-connected central banks team at the World Gold Council. They hold lots of events, have lots of conversations with central banks globally, as well as running an annual survey. And we repeatedly hear that the top reasons that central banks give for why they buy gold are that it has a good performance in times of crisis, it has no default risk, and it's a good inflation hedge and portfolio diversifier. And I think if you take those factors in the context of the current global environment, it's not surprising that those factors mean that gold remains very relevant to central banks in their reserve asset allocation decisions. If we compare last year with more typical long-term levels, so the right-hand bar on the chart here shows last year's buying compared with the average for the previous 10 years, we can see that central banks almost doubled their typical sort of average annual buying. And the chart on the right shows that there was a real breadth of demand. So although we're seeing mainly emerging market central banks buying, the range of those names that are buying is really quite notable. China has obviously been leading the way ever since they began reporting their monthly purchases over the last year and a half or so. They've added the most to their reserves, but there have been notable additions elsewhere as well. And obviously India, the RBI is a key name among those. They've been steadily adding to their reserves on a monthly basis, and I think the latest data out shows that their reserves hit a record total of a bit more than 815 tonnes at the beginning of this year. Now, as I noted earlier, we really think that the fundamentals of demand and supply are what help in explaining the price. And Western investors have garnered quite a lot of conversation and headlines lately for outflows from ETFs in particular. So the sort of professional, institutional side of the Western investor market has been somewhat absent. And there's been questions around how the gold price could sustain its strength without that support from those flows. But I think this chart clearly shows that the strength of the growth in buying that we've seen by central banks has more than offset the reduction in holdings that we've seen from Western-based ETFs. And it's important to note that those outflows have been very much a Western phenomenon. The Asian-listed funds have actually seen decent growth over the last year, contributing to investment gold holdings. Now, at the beginning, I also highlighted jewellery demand last year as being notable. But again, I think it's important when we look at jewellery to take a step back and look at it in its longer-term context. So this is a 30-year history of gold buying. And when you look at the last few years, we're down by around a third of where gold jewellery demand was at its very peak in the late 1990s. But when you consider that drop of around a third against the context of a seven-fold increase in the gold price, I think it really tells that story of a really resilient demand for jewellery. And if you look at the value of what people are spending on gold jewellery globally, that demand has been on a very different trajectory. It's been on a very strong upward path, and we've seen record values of gold jewellery demand in recent years. Now, although we don't expect jewellery demand to actually drive the gold price on a short-term basis, the fact that demand is very robust certainly helps to underpin it and provide that sort of cushioning and support floor under the gold price over the longer term. And just the price-sensitive nature of this element of demand is very encouraging when we see how sort of tremendously resilient it has been over the last year. And if we look at some of the key markets on the jewellery side, we'll see that last year China and India swapped places, China just nipping India in the bud as the largest market. But I think the point to make about India here that's so key is that at a time when gold prices were on average 15% higher, gold volumes only dropped by 6%. And I think that really speaks volumes to the value that Indian consumers place in gold jewellery, that they're willing to increase their spending on the gold jewellery at a time when the prices are rising so strongly. The other part of the physical gold market, gold bar and coin investment, has also been very stable over the last 3 years. And in some ways that might seem counterintuitive. You might expect that gold investors, when they read all the headlines and see how well gold has been doing, that it would attract more inflows into gold investment and push up demand for the market. But the next slide helps to understand and explain this relative stability, because investors in different markets behave differently. Western and Eastern demand often tends to offset each other, and we help to sort of explain this in a way. We say that the gold market is sort of self-balancing. And certainly last year, we saw that very much in play. We saw a very sharp drop in European bar and coin investments, specifically in Germany. And on the other hand, we saw good growth in China, in India, and in Thailand. There was very much that offsetting nature which helped to keep gold bar and coin demand very stable. So that's really a big picture from 2023 of how the global gold market looked. So where are we now? How are we looking today so far in 2024? We don't have our full data set yet. Q1 obviously isn't finished. We'll start to get the more complete data sets in over the next couple of weeks. Our Q1 Gold Demand Trends report will be published at the end of April, when we'll delve into much greater detail in the global picture of all these different sectors. Clearly, we do know that so far in March, the gold price has had a really extraordinary month, and that's bound to have an impact on some of the figures. We also know so far that central banks continue to buy at a fairly decent pace. It's slowed a little bit when you compare it with the first couple of months of last year, but interest remains very broad-based, and importantly, sales still remain limited. The factors driving demand that I mentioned earlier among this cohort, the fact that it performs well in times of crisis, it's an inflation hedge, again, still remain very relevant, so it's no surprise to us that we continue to see these institutions continuing to buy gold. On the ETF side, we've actually seen the outflows that I was talking about earlier start to slow down. In fact, we've seen the green shoots of some inflows into some of the Western listed funds in recent weeks. This sector is still really quite driven by US interest rates. When are cuts going to happen still seems to really drive these flows. But we think that these Western investors are kind of under-owned in these products, and we certainly expect that when we start to see the first real signs of a US rate cut becoming more imminent, that this sector of the market will return. And in terms of the outlook, what might 2023 hold as a full year? Really, we see three drivers to global gold demand over the remainder of 2024. The price will obviously be a key one, particularly given sort of the extraordinary moves that we've seen in recent weeks. The geopolitical and political environment, that was already referenced in one or two of the introductory speeches, and also the broader macroeconomic picture. We think ETF Western investment flows will return. US rate cuts will become a very real prospect at some point, presumably in the first half. And when we see that become a more real possibility, we expect that level of demand to come back into these products. They'll also be supported by politics and geopolitics. In this heightened environment of geopolitical tension, that will be a factor that supports this element of demand. And in fact, that's true for most elements of demand in the market. Certainly for central banks, as I've already mentioned, that should keep demand from that sector supported. Presumably not at the same rate as we've seen in the last couple of years, although we wouldn't rule that out. But we expect it to be very high compared with historical typical levels for central bank buying. But geopolitics is actually also a consideration for both jewellery buyers and bar and coin investors too. We know from market research that we've done that bar and coin investors are very aware of and they value gold as a safe haven. And in a year in which there are, an unprecedented number of elections, there are various geopolitical conflicts and heightened tension, we expect that to help support and drive demand for those physical gold investment products. We've also seen instances where it's driven jewellery as well, where markets have had very challenging times, where there's been difficulties that really highlight even gold jewellery's role as a quasi-investment asset, and Turkey last year was a really key example of that. But having said that, we can't ignore the impact of price on jewellery demand, and that's likely to be a hindrance. It's likely to crimp some volumes of gold jewellery demand this coming year, albeit that, as I referenced before, we would expect the value of spending on gold jewellery to really continue to grow and stay healthy. And then to touch on supply briefly, in 2024 we're likely to see mine production breach the record of 2018, but that growth will actually be quite slim, and we also don't expect a huge response in recycling. That might be surprising given what's happened to the price, but we're seeing few markets really show the levels of economic distress that would generate a big response in people selling back gold for scrap. So we don't expect to see a huge response from that sector. So that's my presentation for today. I hope you'll agree it's going to be an interesting and presumably positive year for gold demand. I hope everybody enjoys the conference, and thank you for your time today.